If we want a higher expected rate of return for our portfolio, we have to be willing to tolerate a higher level of risk.
I have two rules about investing. Number one, never invest more money in anything than you can afford to lose, and never invest in anything you don't understand.
One of the big factors for small caps right now is AI.
In the last 2 years, I've seen more AI companies with booths than I've ever seen in my life.
A lot of the key players, in the future are probably a lot of these smaller AI companies.
International's been down for a while, but MSCI EAFE index is up 15%, and the emerging markets index is up 18%. Why are the international markets doing better too?
There's a couple factors there, probably the biggest of which is the dollar is weakening. Trust me when I say volatility is not good. If we want to maximize the compounding growth rate of the dollar, we want to moderate volatility as much as we can.
What are some of the biggest mistakes that you see dentists make in their investing?
Are you a dentist who's striving to build a more thriving, profitable practice without feeling overwhelmed by the numbers? Hey, good news, there is a better way. The Academy of Dental CPA member firms know dentistry. In fact, it's all they do. Our members are experienced CPA firms who specialize exclusively in serving dentists across every stage of ownership. From startups to acquisitions, to optimizing associate income, to advanced tax strategy, practice growth, and transitions, we're here to support your financial success. When you work with an ADCPA member, you get more than a tax preparer. You get a strategic partner, someone who understands dental industry benchmarks, overhead management, collections, dental insurance, compensation models, and all the unique business challenges you face every single day. We bring clarity to the business side of dentistry. While you focus on clinical excellence, we ensure your financial foundation remains strong with advisory that turns data into confident decisions. Join over 11,000 dentists nationwide who have a financial expert in their corner. Visit adcpa.org to find a trusted dental CPA near you. That's adcpa.org, because your numbers should work as hard as you do.
And hello, everyone, and welcome to another edition of the Art of Dental Finance and Management podcast with Art Wiederman, CPA. I'm your host, Art Wiederman. Welcome to the podcast. We're recording an episode today that's very timely and time sensitive. So usually when I record an episode, it might be about tax law, or it might be about management or PPOs or something like that. And we can record it and publish it a month or two later. But today, we're going to be talking about the investment markets. And I can't think of anybody better to talk to the investment markets. My good friend, Joe Kalinowski from Earned. Joe's firm is a member of the Academy of Dental CPAs, which is my mothership and a sponsor of our podcast. Joe and I have been friends and known each other for well over 20 years. And today, we're going to talk about the investment markets. And we're also going to talk about what you should be doing to build your wealth, how to build a portfolio, and some really good advice. So listen to this. This is one of the most important episodes we do every year where we talk about the investment markets, and I'll get to Joe in a moment. First of all, folks, I want to thank our sponsors, and we have the Academy of Dental CPAs. Again, that is 25 CPA firms across the United States. As I mentioned, Joe's firm, Earned, is one of them, that represent over 12,000 dentists. Go to www.adcpa.org to find the dental-specific CPA in your area. And I also want to thank our sponsor, Interview, which is a revolutionary dental device that helps dentists find internal mobility issues in teeth and other restorations below the gum line that traditional x-rays cannot find. Go to www.interview.AI for more information. Please make sure that you like our podcast, become friends with our podcast on Instagram and Facebook and TikTok, I have not looked on TikTok. In fact, I've never been on TikTok, but my producers tell me that we are on TikTok. No dancing will be done by me or bad things will happen. And we have a YouTube page. So with that said, let me introduce my good friend, Joe Kalinowski. Joe is a partner at the firm Earned. He's a dental specific CPA and has been doing wealth management for how long now, Joe?
Art, we started doing wealth management in 1999, so 27 years ago, basically.
27 years ago. Boy, have the investment markets changed. We've got all the statistics of what the major indices have done. We are at, for the first 6 months of this year, virtually all of the major indices are in double-digit growth, and we're going to talk about that. So, Joe, again, you and I have known each other a long time. We've been to lots of fun ADCPA meetings. We've been out hit a little white ball with dimples on many golf courses. So I do know something about you. You have a very interesting hobby, and it has to do with race cars. Why don't you tell us a little bit about that before we get into talking about the investment markets?
Yes, Art. Well, thank you. I appreciate you having me on today. And yeah, racing is just, I think I've had a lifelong need for speed, frankly, that started, on the go-kart tracks with my cousins. And I can think back to just some crazy fun times I had as a kid. And racing takes all sorts of forms. I'm a club racer, so nothing professional or anything like that, but it's super exciting to be able to get out on some of the tracks where the professionals drive and race head to head with other racers. And it's just been a great time. I know you and I talked in this similar venue many, many years ago when you first started your podcast. And I think I was in a hotel in Monterey because I had an event at Laguna Seca that weekend and recorded that from my hotel room. So
I remember that just about before you were going to go. Real quick, what kind of car do you drive and how fast does this thing go?
well, it depends. I have a Mazda Miata, which is in the club racing world is sort of the most common platform for racing. They're affordable cars. We're talking about finance and investing today. And one of the things that I set out to do when I took in the hobby of racing is you can spend a lot of money doing this. And I was not into that part at all. So I wanted to be able to do it
We're into building wealth, not destroying wealth, right?
That's right, right. You can destroy quite a bit of wealth on a racetrack if you're not careful. So I have a couple of Miatas, part of a BMW team that runs in a particular series. I've driven a Spec Racer Ford, a few different cars, all kinds of different racing clubs around the country. I can remember a trip we went and did what's called Chump Car at Daytona in Florida, followed by the 24 Hours of Lemons, not to be confused with the 24 Hours of Le Mans. The 24 Hours of Lemons race in Florida also, it was a sort of I think a 3-week trip where we split it between Daytona and one other track down there. So it was a lot of fun.
Well, maybe, Joe, you and I start a separate podcast, The Art of Dental Finance and Auto Racing, and it'd be a lot of fun. Good little back and forth on that, maybe. So
Yeah.
So tell me about kind of your professional journey. You've been in this business probably as long as I have. Tell us a little bit about where you came from and how you got to where you are today.
I chose the accounting profession out of school because I thought I wasn't exactly sure what I wanted to do, but accounting sort of struck me as the language of business and being able to understand. I thought I'd want to be in business for myself in some capacity, but turns out just based on my age and when I was graduating from college, I went to UC Santa Barbara, graduated in 1985, was originally a computer science major, changed my mind and switched to economics midstream. And of course, when you're going to the career center and there's companies that are interviewing, there's this upstart company up in Washington called Microsoft that was hiring.
I've heard of it.
Yeah, hiring all the computer science people from UCSB that year. And I thought, I want something a little more solid than that. Anyway,
Yeah.
perhaps I should have stayed with computer science, but nonetheless, accounting is where I landed. I've been, December of this year will be my 38th year with the firm.
Wow.
We joined forces with Earned back in 2024. As I mentioned earlier, we started wealth management in our firm in 1999. Quite frankly, we work pretty much exclusively with physicians and dentists. And in that capacity, we also did a lot of retirement plan administration and retirement plan design for dentists. And back in the early 90s, we were putting together some great plan designs and so forth. And then we were watching clients just literally get abused, frankly, for lack of a better description, by their brokers or whoever's helping with the investments in the plan, and just selling really inappropriate products into the retirement plan, not really paying attention to the real needs of the clients and so forth. And that's kind of what motivated us to get into wealth management in general, just as a means of helping our clients. We try to take clients from, hey, we're not selling you investments, we're buying investments for you. So we picture ourselves as their fiduciaries sitting on the same side of the table, picking, the strategies that are right for them, not trying to sell whatever product du jour is available. That's how I ended up here today. And along the way, got to meet some pretty cool people. Top of that list would be you, my friend.
And you are required by law to say that so that we continue this podcast, or I'm just going to cut
That's
you
right.
off. You know that.
That's
right?
right. Yeah.
There you go. Let's get into the stuff that everybody wants to hear about, is the investment market. So I used to do a radio show. I don't know if I ever told you this. I used to do a radio show. It was on KRLA in Los Angeles right around 1998, 1999, 2000, right before the .com. I interviewed a guy, Joe, who wrote a book called Dow 36,000.
Mm-hmm.
And it was fascinating. At that point, the Dow was about 12,000. And, he made the point in the book that stocks were dramatically undervalued. And for those of you, when we talk about the Dow, remember, when you hear on the news the Dow Jones Industrial Average, everybody thinks, well, that's the entire market. No, that's the 30 large cap stocks, the big boys. It's 30 stocks. It's not some other indices we'll talk about. The Dow didn't get to 36,000 until November of 2021. And it's gone from 36,000 to it is now touching 53,000. So, Joe, let me ask you a question. Let's start talking about large cap and the big boys here. The Dow is up 10.1% this year. The S&P 500 is up 9.3%. Are you nervous that this markets just seem to keep going up and up and up? What do you think about the trajectory of these markets into mid-2026?
Well, Art, honestly, you kind of just made the case for, whether we should be worried or scared. We want to be concerned, obviously, about what stock valuations look like and so forth. But, 1999 was a number of years ago. But the idea that the Dow would hit 36,000 was sort of pie in the sky to people at that point in time. The markets and the economy, private industry, publicly traded companies is a dynamic environment. And I'm not concerned per se in terms of, is the market overvalued? Mainly because, we're not in the business of trying to predict what a stock is going to do, going forward. We're more about sort of structuring portfolios that are right for each individual client. But the reality is, yes, we've got high values particularly on the mega cap stocks. As you point out, the Dow represents 30 individual companies of a total marketplace of, well over 6,000 companies in publicly traded markets. So I don't try to guess what's going to happen. I'm not a forecaster of the markets, but I believe we're going to continue to see, capital markets appreciate over long periods of time. In the near term, you can appreciate that stocks have the potential to go down. We've seen that on numerous occasions over the course of the history of the stock market. The result of sort of this immense growth in large cap stocks is you're starting to see it, frankly. We've seen performance, outperformance, if you will, in other asset classes over the last few years, even though large cap has done very well. Because of that, I think we're seeing some rotation away from the large cap, moving to, small cap stocks as an example. Everyone thought 36,000 for the Dow was pie in the sky in 1998 or so, whenever that book was written. Obviously, that's ancient history. Did you ever watch 2001: A Space Odyssey?
Sure.
I think that was in 1968, when that movie was.
Yep, I think you're right.
If you look back at how many things were shown in that movie that we actually have in reality today, it's kind of scary. So that movie was way early. The prediction of 36,000 on the Dow was way early, but we got there. Investing in the stock market is and should be a long-term strategy. And as it relates to our audience today, I think it's really important that folks understand that. I talk to clients all the time about having a play account or an account where they can, sort of try to guess what's going to be the next hot AI stock. But, as it relates to their retirement plan and the greater proportion of their portfolio, we want a little more structure and discipline to that approach. So the valuations are high. Yes, I agree. Does it scare me? No, it doesn't. It's just how much are we implementing a disciplined approach to how we allocate our assets across these market classes. In a hyper simplified example, if I have a client who wants their investment policy to be 50% large cap stocks and 50% fixed income or bonds, obviously as valuations like this are happening on the stock side, we're going to be absent any new money coming in. I would just by discipline be selling those large cap stocks, buying fixed income. The stocks continue to go up. I sell some more, buy more fixed income. We're about that sort of discipline of maintaining that allocation, not predicting what asset classes are going to do next week, next month, or next year even.
Right. And there's a couple points to make that I have in my golden rules, Joe, that I lecture on and have for years. I have 2 rules about investing. Number 1, never invest more money in anything than you can afford to lose, and never invest in anything you don't understand. And how many dentists have you and I worked with who said, I have the next greatest thing? And I have one guy who told me he lost his entire retirement plan in 3 days working with a guy who swore he was an expert in options and futures, and I just cringed. But the thing about large cap and bigger companies, everybody thinks small cap companies are little companies. No, they're still big companies.
Yeah.
There are very, very smart people running these companies, and they know how to pivot and when to pivot, because at the end of the day, Joe, isn't it true, no matter what equity you're investing in, the earnings of a stock and the price of a stock is based on its earnings. If that company is doing well as a general rule, okay, then that stock is going to go up. Now, we understand that there are geopolitical things going on in this world that somebody makes a statement or somebody does something and the markets go up by 1,000 points or down by 1,000 points, but that's not the breadth of it. I mean, the basic concept of stocks is that if a company has good earnings, the stock is going to go up. If a company doesn't have good earnings, it's not going to go up. Does that make sense?
It does. It's slightly different than that. But the market is valuing those stocks is based on the market's expectation for the growth in that earnings. Right. So what happens to a stock that crashes down is basically expectations were unmet, generally speaking. So the typical scenario is there's an earnings call. Publicly traded companies have to be public and transparent. And so they have to disclose earnings on a quarterly basis. And if the stock was bid up because investors thought that the earnings growth was going to be at X, and then the earnings call happens at the end of the quarter and they didn't meet that, they're going to get beat up. It's almost like a little bit of microeconomic theory, if you will, or supply and demand, right? So if we think a company like SpaceX, as an example, is going to go to the moon, pardon the expression, but then we want to, that people are going to bid that stock up. Now, SpaceX has no earnings, right? So this is, and back to your point about 1999 and what happened in the dot-com crash, back then it wasn't about earnings. You just had to have revenue. If you had a company that generated revenue, you could see some radical appreciation. Somebody was going to start a company where they were selling dollars for 75 cents. And, that was going to make this huge growth in the equity valuation of this company. And you might see that for a minute, but obviously that doesn't hold up over time. I think you're partially correct. Earnings are a big part of it, but the valuation of the stock is largely based on the market's expectation for what the growth in that earnings is going to be.
That's why you're the brains of this operation, my friend. Let's just hit a couple of categories quickly, because then what I really want to get into is how do we structure a portfolio? What's the thinking behind it? And I want to get into what our doctors should be doing to plan for the future. Real quick, The small cap stocks are killing it this year. The Russell 2000 is the index that's the small cap stock index. It is up 20.7% in the first 6 months of 2026. Why are small cap stocks doing so well right now? Is it maybe a little bit about what you said earlier?
Yeah, I mean, there's a number of reasons. And again, just to your point for the audience's understanding, small cap stocks, as it relates to like the Russell 2000, these are companies that are publicly traded that are, generally are valued somewhere between $300 or $400 million and $2 billion. So these are not,
No, they're not tiny
the-
companies.
they're
No.
not tiny companies. It's not a collection of lemonade stands or anything like that. So they perform because they're smaller companies. They're more sensitive to some factors maybe that big companies are not. So larger companies, as an example, can issue debt or bonds. Small companies are less likely to do that. They're more likely to rely on bank financing or BDCs, business development companies, to provide credit to them. So the expectation of maybe stabilizing interest rates has a large part to do with why small cap stocks have done well this year, I think. I mentioned earlier, I think there's a little bit of a rebalancing effect because large cap has gone to the moon over the last 3 years. And so people are rotating, if you will, away from, the larger cap, mega cap stocks. So again, the theory of supply and demand, that people are buying more small cap stocks, that's going to drive up valuations, which enhances performance. And quite honestly, I think one of the big factors for small caps right now is AI. And many of the players, there are the NVIDIAs and Microsofts and Googles, who have big AI influence. But a lot of the key players, in the future are probably a lot of these smaller AI companies, and people want to be there. That's driving demand. That's driving valuations up. And, that translates into higher returns for investors.
And the NASDAQ is up 11.1%, and it's not coming from the Magnificent Seven. Those
That's right.
seven tech stops, the Googles, the Alphabet, those companies. It, like you were saying, a lot of AI companies, that is the big deal. When I was at the California Dental Association convention, in the last 2 years, I've seen more AI companies with booths than I've ever seen in my life.
Mhm.
And that's a big deal. I want to jump to international stocks for a second. International's been down for a while, but MSCI EAFE index is up 15%, and the emerging markets index is up 18%. So internationals, developing markets, Europe, Japan, and Australia, and emerging markets are doing better. Why are the international markets doing better too?
There's a couple factors there. I think probably the biggest of which is the dollar is weakening
Yes.
a little bit. That's probably the biggest contributor, and that just translates into greater appreciation for holders of foreign securities and emerging markets. I think that in the international markets, or the international European governments, as an example, are investing more, I think, than the U.S. currently in infrastructure and defense, and trying to be more independent. I don't have scientific basis for what I'm telling you here, but you can't really say what's driving market valuation per se, right? It's very subjective. Geopolitical issues have a significant impact. Many people thought, because international's been doing well for the last, we're into like the third year of pretty good performance for international markets. But as you point out, coming off a period of many years of underperformance relative to what the U.S. markets have done. It's really more and more evidence to the importance of diversification in your portfolios. And if you got out of foreign stocks because they were underperforming for a significant period of time, 5-6 years ago, you've missed out, and the long performance has been super normal and beaten the U.S. markets over the last couple of years.
I want to touch on bonds. Then we're going to talk about how to structure a portfolio for doctors at different stages, and we're going to get deep into that. Just talk a little bit about bonds right now, Joe. The investment grade bond indexes they're pretty flat, up about 0.5%. Yields are around 4.5%. I mean, talk about the bond markets. Even I have always been confused about, when you buy a bond, there's two parts of the return. There's the interest you get on the bond, and then there's the growth in the valuation of the bond. Talk about what bonds are doing right now.
Bonds are obviously, if you think about running your business, the money that you put into your business, your own investment, that's kind of your equity investment. If you have bank debt to satisfy the needs of the company that you're building, in your practice at some point in time, Art, back in the day, you had debt that you added, bank loan, a line of credit for whatever it is.
Sure.
Bonds are similar instruments that big companies use to create financing or money to run their business without giving away equity. So they borrow money as opposed to selling stock. But the way, as an investor, the way bonds affect your portfolio are, they're much less volatile than stocks, but their appreciation oftentimes is tied to what the market rates interest rates are doing in the marketplace as a whole. So as an example, if you bought a bond last year, let's say you bought a bond last year that was a 5-year bond and it paid 3%. If you could go out and buy that same bond today, if you bought a 5-year bond a year ago, if you could buy a 4-year bond today, so you have the same maturity date as your bond you bought last year, and it paid 2% instead of 3%, you can appreciate that the value of the bond that you bought last year is now worth more than what you paid for it.
Right.
That's sort of bond math, if you will, just in super simple terms. It's driven by what interest rates are doing. So again, as interest rates stabilize, the bonds they're going to deliver, as an investor, they're going to deliver the yield that they pay out, but you won't see necessarily a lot of appreciation or depreciation in those bonds if rates stay consistent. It's the movement of market interest rates that drive the ups and downs of the value of a bond.
And so bonds are a very important part of a balanced, diversified portfolio. Again, we're going to get into that. Joe, let's take a second. I want to talk a little bit about we at the Academy of Dental CPAs. I mean, this is the premier group of dental CPAs in the country, if not the world. And, you and I have been part of it we just celebrated our 25th anniversary, and many of our firms, including Earned, do wealth management. So talk a little bit about what a dental CPA firm like yourself would do, how you manage money, how you help doctors. We're going to get into doctors at different stages of their careers and get a little more granular, but just talk in general terms about what you do. And then I want you to, again, doctors, if you're looking for an ADCPA member, the website is www.adcpa.org, and you can click on the map and get the person in your area. But Joe, talk a little bit about how you guys do what you do, and then I want you to give out your contact information if anybody has questions about, what does a dental CPA do? And we all work with each other at the ADCPA. We're all really good friends. But Joe's going to tell you a little bit about how he does what he does.
Well, yeah, thanks, Art. So as I mentioned, as you know, and many of our colleagues in the ADCPA have a similar sort of structure, we're somewhat unique in that we are CPAs and wealth managers. So we think that adds a lot to what we do. And part of that is because everything we do, whether it's certainly on the accounting and tax side for clients, but also on the portfolio advisory services that we do, we're always looking through the tax lens. It's really important to, sort of focus on the importance of taxes in your investment portfolio. So our process, if you will, in terms of, how we would, take on a new client, the first things first, I want to get to know clients. I want to know, help understand and make sure that I'm in sync with them on what their needs are, what their wants are, what their wishes are. We try to get a sort of clear understanding of that. Many of our clients that we do wealth management for have come from the tax and accounting side of our business. And, it gives us sort of a unique insight into what's happening in their business and on their tax return. So as part of that process in the early stages, after sort of getting to know, hey, where do they stand? What sort of timeline do they have? We want to understand what their risk tolerance is. So because you can appreciate that as you build a portfolio of investments, it should be built around, you're going to have some equities or stocks in that portfolio. You're going to have some bonds, and you might have some other alternatives, if you get into private investments as opposed to publicly traded investments. So there's a lot of different investment vehicles out there. If you've seen one approach to investing, you've seen one. Everybody has a different opinion. But one thing that's sort of a common thread in the world of portfolio management, investing, whatever you want to call it, is there's a correlation between risk and reward. So if we want a higher expected rate of return for our portfolio, we have to be willing to tolerate a higher level of risk, meaning we're willing to buy more equities. So as part of the sort of onboarding process, one of the first steps is we have clients complete a risk tolerance questionnaire. And one of the things that's surprising to me is the number of times that I just had a new client who came in within the last month. She took our risk tolerance questionnaire and she scored a 30 out of 100. Based on the answers to her questions, you would think she's not super risk tolerant and concerned about, losing money, et cetera, et cetera. Her portfolio was 90% stocks, 10% fixed income, and she's in her mid-70s. There's a big divergence or a question mark there that is a great conversation starter to helping people understand, where they really are. And that conversation comes down to what we're leading towards is the development of an investment policy. So part of what we do in working with our clients is once we understand their needs, wants, and wishes, that helps us ascertain their need to take risk. Okay. And the portfolio or the investment policy and how it's built is going to be based on what we mutually agree with the client on their need to take risk, their willingness to take it, and their ability to take it. Those are sort of three key factors in building that portfolio. And the goal is set by the client. Through our conversations, we're going to assess, what their goals are. Is it, do they want to leave a legacy for their children? Are they going to fund, graduate education for all of their grandchildren? Are they hoping to come sliding sideways across the finish line at the end with $1 and, consume their entire estate?
Swallow your last dime, we call it.
That's right. So, through that process of getting to know clients, we're able to, help them build these portfolios that are very structured, very disciplined, very tax centric. So, and what I mean by that is that, we care about where we hold certain assets. Most dentists have a good portion of their wealth, frankly, in their retirement accounts. And so, as an example, in retirement accounts, this is a classic scenario. In retirement accounts, you're going to have a big portion of your investments. Part of that allocation, as we can appreciate based on our earlier conversation, might be foreign investments. So foreign investments have a unique aspect to them in that if you're using ETFs or mutual funds, they generally throw off foreign tax credits. Foreign tax credits don't do you much good if that asset's being held in an IRA. So you're giving away a tax benefit, okay? And sometimes we talk about taxes maybe a little too much. I mean, we're CPAs, we're tax geeks, right? So, but the reality is a lot of our wealthy retired clients can honestly look back over the course of their lifetime and say that if not their largest single expense, definitely amongst the top 3 is tax. So it is not an insignificant factor in terms of building your portfolio. So where you hold assets, the timing of disposition of assets, there's a lot of things we do as an advisor in managing the tax aspects of your portfolio.
Hey, it's Art Wiederman here. You know I don't recommend products lightly. I only share solutions that can genuinely impact your practice's clinical outcomes and bottom line. That's why I really want to tell you about Interview. They've developed an FDA-cleared technology that measures internal tooth mobility, something that traditional methods just can't detect early enough. Here's what that means for your practice. You can identify cracks and loose restorations before they become emergencies. That means better treatment planning, fewer surprises for your patients, and more predictable case acceptance. Interview integrates right into your existing workflow. No complicated processes, just clever diagnostic information when you need it. it. If you've been looking for a way to elevate your diagnostic capabilities and strengthen patient trust, book a demo at interview.ai. That's INNERVIEW.ai. Mention my name and you'll get $250 off. That's Interview AI. INNERVIEW.ai. One of the major things, Joe, that we all talk about is the use of qualified retirement plans and the ability, if you have extra money and that comes into your budget and your personal financial plan, of putting away tens, if not hundreds of thousands of dollars annually into these plans. Starting early, we're going to talk about different ages here. The folks at the ADCPA are your trusted advisors. These are people who are vested and invested in your success. Every single member of this group is a friend of mine, are just some of the finest human beings I've ever met. And we talk about investing. Joe and his group have actually brought some very interesting, something called tax loss harvesting when you sell a dental practice, to introduce to us, which is really cool. We'll chat about that before we get off the air today. So, Joe, would you do me a favor and give out your personal contact information? So if anybody who's a dentist has a question about investing, give Joe a call. He can talk to you about ADCPA and all that kind of stuff.
Yeah, thank you, Art. So welcome your contact. Best way to reach me is probably email. My email address is joe@earned.com. Pretty straightforward. Our phone number here is 877-939-2500. That's toll free. We're in the 925 area code up here in Walnut Creek, California. You can go to our website at www.earned.com. We've got a lot of cool technology and an app for your iPhone, kind of have your financial life in your hand with your phone, which honestly, that's where Stanley Kubrick missed it. Okay. You might remember from 2001: A Space Odyssey that there was this gigantic phone booth where he was making the phone call, right?
Yeah.
So Kubrick completely missed the fact that the phone was going to be right here.
And that you weren't going to dial it.
Yeah, that's right. But he did nail the fact that there were like flat screen displays all over the place, right? When in 1968, the television weighed about, 100 pounds. Anyway, I digress.
Yeah. We'll put Joe's contact information in show notes. Again, doctors, if you're looking for a dental-specific CPA who can handle all of your financial needs and who understands the difference, as one of our members talks about, Bob Gray talks about the difference between medial and distal, give us a call, www.adcpa.org, and check in with Joe about some of the things that they do. All right, Joe, I want to hit in the last 20 minutes or so that we have together. Let's start out with a doctor who is just getting going. Maybe they're an associate dentist. Maybe they just bought a practice. They're in their late 20s, early 30s. When you start with someone like that, what are the questions you ask and what should they be thinking about?
I guess one of the biggest challenges that I've seen and experienced with younger dentists who are just getting going is you have to sort of resist the temptation. I appreciate that, all of you out there in the listening audience have spent an awful lot of time in school. And so by the time you graduate and you're working and you're starting to make some real money, there's some pent-up lifestyle that has been waiting to be unleashed on the world. You have to manage that in the early years. So if you're out there buying a practice, as an example, you hear us talk about retirement plans a lot. You want to start early and often when it comes to saving, whether it's outside of a retirement plan or certainly inside of a tax-advantaged retirement plan, which is where a lot of you will be accumulating a decent amount of wealth. Just it's the nature of a professional practice, and you're going to have that opportunity. So, and I think it's important to do that often. Again, the commitment to savings is critical for two reasons. Number one, you understand how money compounds over time, and the compounding growth of a dollar that's invested in a disciplined, structured way can be significant over the course of your career. The other reason it's important is because money that you commit to savings is not used to increase lifestyle. And in an ideal world, we want you to have a tremendously successful career, family, support your kids through their education, etc. But when you retire from practice, we want that lifestyle to maintain. We don't want to have, if you look at the lion's share of people around the country, all walks of life, most people when they retire have a substantial adjustment in their lifestyle. We don't want that for our clients. Most clients don't want that. They want to have some consistency. So that's a lot of what we talk about with younger clients. And I take them through my life math, as I call it. So one of the things we do in planning for clients is we're building a financial plan. We're stress testing the ability of their investment practices to sustain them in retirement. So part of that is, hey, how much money do you spend for your life? And it's not uncommon for a client to say, Joe, yeah, we spend about $25,000 a month. It's a decent amount of money. And I'll say to them, usually in that course of that conversation, I'll say, hey, that's great. You guys saved, what, 50 grand or something last year? And they'll say, well, no, actually, we really didn't save much money at all. So then I have to take them through the life math equation, which is, it starts with how much money you make. And by the way, I do your tax return, so I know what that number is. Okay. From that, we subtract the taxes that you pay. By the way, I know that number too. From there, one of two things happens. You save it or you spend it. So I have the income, the taxes, and you told me how much you spend. So one of these numbers is not right.
That's right. And here's another thing, Joe, that doctors, you need to consider, and I'd love your take on this, is so when you own a practice, and again, my joke when I get up on stages, I always ask, is there an IRS agent out there and am I going to be taken away in handcuffs, right? But we all know that there are things that are paid. One of my clients referred to it as a bisinal expense, which is a combination of business and personal. And Joe and I both know what those mean. And doctors, you know what that means. You're paying for this or that, or this trip, or that visit to this store, or this on Amazon, or whatever that happens to end up being paid through your practice. Well, doctors, when you sell your practice, you're going to get hopefully a nice chunk of money that Joe and our 80 CPA colleagues will be able to invest for you. But you're not going to have a practice to run that stuff. So not only is that $25,000 a month, Joe, that you're talking about that they need to live on, they got to add to that whatever else they've been running through the practice that they can't do anymore, right?
That's right. That's right. A common oversight that's not as much an
Common
issue
oversight.
for the younger docs, but yeah, as you transition towards retirement, you have to consider that, right? You look at your personal checking account and you say, hey, this is how much money we've spent, but you forgot that half of your vacation was actually continuing education, right? It was your trip to Anaheim for the CDA meeting. Then the whole family came along so you could go to Disney.
Exactly.
That's a very good point.
And that's
Art.
a month's production to be able to go to Disneyland. We know that, right?
That's right. And that's partly because, when you're gone, the overhead keeps running but you're gone and the production's not happening.
And there's no revenues coming in when you're not working.
That's right.
Let's go to a couple of other food groups. Let's say, so now we're talking about a doctor, they're in mid-career. They're in their, late 30s, going into their 40s, even their early 50s. And they come to you. What is the emphasis at that point? You got the highest earning years. I think they're probably more in the 50s and 60s, but still you got doctors that they're in the middle of their career. They're raising their families. Maybe they're buying the big house now. They got 2 or 3 kids. They're planning for college. How do we approach investing for someone in their 40s and 50s?
Well, again, in terms of how the portfolio would be invested is largely going to be driven by the financial plan, for lack of a better description, or the stress test that we do. So the beauty, or I guess the importance of getting someone in the sort of mid-career, high peak earnings period is to help them understand the math that it's going to take to be able to maintain their lifestyle into retirement throughout the rest of their life and meet their goals. Again, when I say goals, everybody has different goals. Generally speaking, it's not being able to tell the best story at a cocktail party about the investment that you made. It's making sure that your family is taken care of and your desires are met with the least amount of risk possible. So we want to meet with clients who are in their peak earning years because that's when oftentimes lifestyle can grow too much. And if you make $400,000 or $500,000 a year and you think that just funding your retirement plan to the max every year is going to sustain that in retirement, your math is not correct. So it's going to take more commitment to savings outside of your retirement vehicles to make the numbers work. Because we've got some life cycle on the practice, we know it's more predictable. We've got a good, solid practice that we're building on. We can implement more what we call practice integrated wealth management. So, in other words, this is all math. It's all numbers. So if I know, I can look at a practice and say, I know what the fixed overhead rate of I know what the fixed overhead dollars in a practice are, and I know what the variable overhead rate is. I can predict how much additional production somebody might need to generate X number of dollars on the bottom line. Well, I can continue that math all the way down into their financial plan, right? So if through the financial plan process, I know that, hey, Doc, you need to be saving outside of your retirement plan an extra 50 grand a year. Okay. By the way, here's how you're going to generate that. You need to see another half day a week, and that money is just going to trickle its way down to the bottom of your financial statement in the practice and into your brokerage account where it can be invested and help you meet your goals. That's really the key part for somebody who's mid-career, if you will. Does that make sense?
Yeah, and that right there, folks, is the difference between someone who's trying to sell you an investment because they're going to get a big commission out of it, and someone like a Joe Kalinowski and people at the Academy of Dental CPAs who are going to say, you know what, you need to save an extra 50 grand. And if you were to add another day of hygiene in your practice, this is the revenue that's going to generate. And he understands how to run these numbers. And things like what you and I have talked about before, where doctors say we're talking about someone in their 40s and 50s. Maybe you bought your practice when you're 35 years old and you get a 10-year loan from the bank, right? And now you're 45 and that $7,000 or $8,000 a month loan is going to pay off. I don't want you to spend that money. I want you to go to someone like Joe and say, all right, Joe, I've now got an extra $8,000 a month that's going in my pocket because that loan is paid off. And Joe's going to say, all right, well, we got these 3 kids here and they're all A students and they're probably not going to community college. And they might be going to a school starting with some letter like a Yale or a Stanford. So we got to
Right.
save for that. So let's take $2,000 a month and put that in a college fund. And then, maybe we want to pay our house off when we're 65, and maybe we'll take another 800, and then we're going to put the rest and beef up. That's the kind of stuff that you do, right? And that our ADCPA members do.
100%. That is critical.
Yeah, very critical. Let's get into a doctor who's in their 60s and 70s, and now we're getting towards the end. And doctors, as I say in every podcast that I do, virtually every one, this is a call to action. Okay, we're not going to tell you today, Joe's not going to tell you today which stock or which mutual fund to invest in. We want to give you a roadmap so that you can have the ability to walk away from dentistry if you so choose. Because what ends up happening is in the profession of dentistry, neck, back, shoulders. I mean, 3 out of 10 of the dental practices that I sell every year are because of a disability. So if you get to this age and you can't do this anymore, and you don't have enough to retire on, you've got a problem. So talk about doctors in their 60s and 70s, and maybe a little bit, Joe, about how you plan for now the exit. We've done the accumulation part. Now we're talking about the spending, the fun part. We've saved this money. Now we're going to spend it. How do we accumulation and then now getting out of the profession?
Yeah, no, good point. And Art, I think it's important that, the planning for that period of time needs to start before you get to your 60s and 70s, obviously. But it is a critical time in the evolution of your, sort of family legacy. Again, keeping the tax lens on, we want to make sure that we're being disciplined in our approach to how we're managing that. So as an example, for people in that situation, the things that we're typically doing are, we're talking about, I guess, let me frame the situation. Today, let's say as an example, you're going to sell your practice. Somebody in the audience today is in their early 60s. They're looking at a DSO. They've got an interested doctor down the street that wants to buy the practice. There are strategies that you can implement today that are going to help you significantly as you go through this transition of selling your practice. One of the things that keep in mind, if you sold the practice at 65, you're not required to take money out of your retirement account until you're 73 in the current law. So we've got an 8-year period of time there that we call the blackout period. So from a tax planning perspective, it's a huge opportunity to do strategic Roth conversions. It can create some significant generational wealth. You can implement charitable strategies. If you're somebody who's very charitable, there's lots of things you can do using a donor advised fund. Depends on your goals there. As Art alluded to earlier, accelerated tax loss harvesting strategies. We have some amazing strategies that can shelter the gain on the sale of your practice in a very efficient way and be part and parcel to your overall investment policy and still be delivering investment return, helping you make your goals. Social Security optimization, asset protection, asset location. Again, where we want, assets that produce ordinary income. We want those in your retirement accounts because they're tax sheltered. If they throw off capital gains, which are more tax efficient, we can have those in your taxable account. If they throw off foreign tax credits, those should be in your taxable account. So all of these things, the timing of when you withdraw money from your retirement accounts, all of these things have a radical impact over the course of your life in success or failure. It's not really failure per se, it's more like relative success.
And doctors, you will be very thankful to anybody at our ADCPA group, people like Joe Kalinowski. I'm sure, Joe, you've had doctors who've come up to you who've been 20, 30-year clients, and now you've been able to guide them from the cradle to retirement. And now the plan they've followed it, they've done what you've said, and now they go ahead and they're ready to move on to the next phase of their lives, and they say thank you. And that is one of the most gratifying things that you and I get out of what we do. And
Well,
I know you've had it happen to you, and I've had it happen to me, and all of our ADCPA members have it happen. I want to put a bow on this thing. What are some of the biggest mistakes that you see dentists make in their investing and their planning?
Single biggest mistake is chasing returns. It's common human behavior to, read about what's happening with, if you've been in Nvidia from the beginning, you're sitting pretty on that investment right now, admittedly. Okay. If you invested in a diversified portfolio, you have Nvidia too. Okay. You just don't see it on your statement. Okay. But if you own the S&P 500 fund, you've got Nvidia. So important fact. That's one of the big mistakes that people make is trying to chase returns to, in quotes, beat the market. Okay. The lion's share of your portfolio, if you start early enough, will in fact be the earnings on the portfolio and the appreciation of the portfolio.
Yep.
But and the longer you wait to start that process, the bigger the component is your actual contribution to those accounts. So your savings, the principal of your savings. So I encourage an early start to savings, whether it's outside the retirement plan or inside the plan. The other thing is just sort of this disconnect between the expectation and a true understanding of the amount of risk that they're taking. As we assess people's tolerance for risk, it's really important to sort of stay in touch with that. Bonds, even though they're not super sexy, not providing like crazy high returns, they do provide an important part of a portfolio in that they modulate the volatility of the portfolio. And trust me when I say volatility is not good. Okay. It can be indicative of high appreciating stocks, but they move a lot. But let me give you a super simple example. You have two mutual funds and you look at them and they both have averaged 0% for the last 2 years. Okay. In portfolio number one, you invested $100 and it returns 0% in year one and it returns 0% in year two. After 2 years, you have $100. The second fund, you put in $100 and in the first year, it returned 50%. So now you have $150. In the second year, it lost 50%. Now you have $75. Both funds average 2-year return 0%. $100 becomes $75 with volatility. So If we want to maximize the compounding growth rate of the dollar, we want to moderate volatility as much as we can.
That is volatility, diversification. And folks, we are in an environment today with our geopolitical situations that there is definitely volatility, and like we've not seen in many, many years. Joe, I want to thank you for your great information, for your friendship over the years, for what you've done with the ADCPA, some of the great information you've brought to our group. One more time, give out your contact information again, doctors. If you are not working with an ADCPA member, you need to be working with an ADCPA member. www.adcpa.org and go to the map and the folks in your area. But if you want to get a hold of Joe and have some questions about investments or portfolios, Joe, what's the best way for people to get a hold of you?
You can email me, joe@earned.com. That's EARNED.com. You can call or text me at 925-280-5706. That comes direct to my desk or direct to my text messaging. And Art, thank you so much, my friend. It's been great spending an hour with you here today, and I look forward to standing over a little white ball with you again real soon. Yeah.
Anytime. Anytime. Stay with me as I take the podcast out, Joe. So, folks, again, this is a call to action. If the conversation that Joe and I just had resonates with you and you say, I've been putting this off. I know I've got to start planning my financial future. I know I've got to plan for the kids and college and retirement. And I know I'm going to have to take care of mom and dad. Now is the time to say, let's just start taking some action, make the phone call. I want to thank our sponsors again, the Academy of Dental CPAs, www.adcpa.org, and Interview. Go to www.innerview.ai for a device that helps find internal mobility issues in teeth below the gum line that traditional x-rays can't find. And with that, I want to thank all of you for the honor and privilege, as I do twice a month, for your time. And this is Art Wiederman for the Art of Dental Finance and Management podcast with Art Wiederman, CPA. And we'll see you next time. Bye-bye.